Mutual funds, index funds, and ETFs. These words get thrown around a lot in the investment world, and without proper knowledge of the advantages and disadvantages of owning each of these different funds, it can be hard and often costly to make investment decisions. By the end of this video, you will be well versed on the basics of each of these three funds, and this will enable you to make investments which are tailored to your needs. We will take a look at mutual funds first, followed by index funds, and then finally ETFs. Number 1. Mutual funds. From Investopedia, we learn two things. Number 1. Mutual funds are a type of investment vehicle consisting of a portfolio of stocks, bonds, or other securities. Number 2. Mutual funds give small or individual investors access to a diversified and professionally managed portfolio. These definitions might seem daunting, but do not worry, because as we explore the advantages of mutual funds, these long sentences will all make sense. That said, mutual funds have three major benefits. Number 1. Convenience. Number 2. Diversification. And number 3. Portfolio managed by investing professionals. So, what makes mutual funds convenient? When you invest in a mutual fund, you get ownership of many different stocks, all in one package. This is because a mutual fund can hold up to hundreds of different stocks, and when you purchase a single mutual fund, you get instant access to all the different funds that the mutual fund has. As an example, say you wanted to buy 90 different stocks, and with mutual funds, you get the ability to buy all the 90 different stocks at once, instead of buying 90 individual stocks one by one. This definitely saves you lots of time, and at the same time, owning all these 90 different stocks helps you to diversify your portfolio. So, this is how diversification is a benefit that you get when you invest in mutual funds. Now, you must be wondering, what is the need for diversification in your portfolio? Diversification is an investing strategy that enables you to reduce your investing risk by spreading out your investments into all the different stocks of the mutual fund. You must have heard of the saying, never put all your eggs into a single basket. And this is what diversification does. As your money is spread out across different stocks, even if one stock crashes, you don't incur a fatal loss, as you own only a small fraction of each stock in the mutual fund. The third advantage of owning a mutual fund is that you don't need to put in any work to manage your investments. When you invest in a mutual fund, your portfolio will be managed by investing experts. In this way, you don't have to go through the trouble of researching any stock that you wish to buy. Instead, just leave it to the professionals and they will do all the hard work and then choose the best stock for you. At this point, you must be thinking, wow, mutual funds are so amazing. But the truth is, owning mutual funds is not without its disadvantages. All is good to the extent of the convenience and diversification that mutual funds provide. But the aspect of having investment experts manage your portfolio can be damaging to your finances in the long run. When investment professionals do the stock picking and managing for you, it is called active management or actively managed mutual funds. The biggest drawback of relying on active management is that the investment experts charge a lot of money for the services. Also, when professionals manage your account, they charge a fee of up to 2% of your account balance every year. And you will not be very pleased to know that even if your account balance goes down, you will still be required to pay your managers the 2% fee of your account balance. Let's take a simple example to understand the scenario better. Say the fee the manager charges is 2%, and you decide you want to invest $10,000 in a mutual fund. Each year, you will have to pay $200 to your account manager, and you'll have to make this payment irrespective whether you are making a profit or you have incurred a loss. At the end of the day, the professional manager, even the experts in their field, are humans after all, and humans tend to make mistakes sometimes. So, if your stock manager picks the wrong stock, only you will have to bear the loss. This situation can often leave you with less capital than when you started your investment. In my opinion, it is not worth paying high fees to professional managers to run your account, as they can often make mistakes and this will put you in a tight spot. Now, let's learn about another investment vehicle, which are index funds. An index fund is a category of mutual fund that was first created in 1976 by Jack Bogle. The purpose behind creating the index fund was to allow individual investors to invest without having to pay high fees to account managers. The best part about index funds is that they are passive investments. This means that you just buy an index fund and then you don't look at it again for a very long time. There's no need to worry about the market predictions or fret over what the charts are saying about a stock. It sounds too good to be true, but it is true. This is because in the long run, index funds perform better, and thus they are considered passive investments. investments. You must be knowing Warren Buffett, right? He is a millionaire investor, and his favorite form of investing is passive investing. Indeed, the rewards that compound interest brings when you invest in index funds is unmatched. In 2016, Warren Buffett wrote in his letter to shareholders, "When trillions of dollars are managed by Wall Streeters charging high fees, it will usually be the managers who reap outsized profits and not the clients. Both large and small investors should stick with low-cost index funds." Basically, the thing that makes index funds so great is that they are passive investments. And let's not forget, when you invest in index funds, you don't need to pay experts to manage anything. And this means more money for you to save or to invest. But how does an index fund work? Index funds follow a benchmark index, such as the S&P 500. When you invest in an index fund, the cash is used to invest in all the companies that form that particular index. And this leads to diversification in your portfolio. And as we know, with diversification, we spread out our investments so that we don't incur huge losses. The best part about this type of diversification in your portfolio is that you do not have to pay huge sums of money to account managers to manage your portfolio. You will still have to pay a small annual fee though when you invest in an index fund. Let's take the example of the Vanguard S&P 500 index fund. The annual fee that it charges is currently only 0.04% compared to the 2% you would have had to pay to professional managers if you invested in a mutual fund. Another benefit of index funds is that you get to do automatic reinvestments. This means that you can set up recurring monthly deposits from your bank account, and the index fund will automatically buy you more shares every month at no additional charge. Now, let's talk about our last topic for today's video, ETFs, aka exchange traded funds. Essentially, ETFs, as the name suggests, enables you to buy and sell your shares in exchange, just like trading on the stock market. ETFs are not stocks, but the principle behind buying and selling shares follows that of the stocks in the stock market. The main difference between an ETF and an index fund is that an ETF can be bought and sold at any time, while index funds are only bought or sold only once a day. Basically, if you like the trading aspect, you should go for ETFs. But if you're looking more for passive investment, index funds will likely be more suitable for you. The problem with ETFs is that it can often lead you to impulsive actions, and this is a sin in investing. This is because when you trade, you are more likely to be affected by the ups and downs of the prices in the charts, and this can trigger your emotional side, and then you can make a hasty decision of buying or selling, which can sometimes make you incur losses. To make smart investing decisions, you need to keep a calm head and not be influenced by your surroundings, and ETFs will likely influence you to keep changing your mind. So personally, I feel that one should stay away from the temptations that ETFs bring. Also, a big downside about ETFs is that there are no automatic reinvestment options like in index funds. Instead, you will have to pay trading fees each time you decide to do an exchange. I hope that you can now choose the best investments for yourself using the knowledge you just acquired. If you found great value from this video, consider subscribing to the channel if you haven't already for more videos on investing